What's the difference between an index fund, a mutual fund, and an ETF? I'm going to explain what each of them are so you know which investment will be best for you. Before we get into it, hit the like button so this video gets recommended to other people that want to learn about investing. And be sure to subscribe and hit the notification bell because I want you guys to become millionaires. It's possible, and I'm going to show you how to do it. So what are mutual funds? Mutual funds were originally created so people could pool their money and make investments together. So we could even word that as a mutual fund is a way for people to mutually contribute to a fund. Inside of a mutual fund, there are a bunch of different stocks, and there is a manager of this fund whose sole purpose is to try to choose stocks that will outperform the market. Fun fact, the ticker symbol for a mutual fund will always end in the letter X. This is a surefire way to know if you're looking at a mutual fund or not. Let's talk about the benefits of a mutual fund. Mutual funds make investing easier. By investing in a mutual fund, you get a bunch of different stocks all in one place. Mutual funds can have hundreds of different stocks all inside one nicely packaged fund. That means you can essentially have hundreds of different stocks all with a single purchase. Think about it, if mutual funds didn't exist and you wanted to have 300 stocks in your portfolio, you would have to individually go and buy every single stock, all 300 of them. Talk about time consuming and talk about expensive. You'd have to sit there in front of your computer for hours just clicking buy. By investing in a mutual fund, you automatically get ownership of all of the stocks that are already inside of it. Owning a bunch of different stocks is one of the major benefits of a mutual fund because it gives you diversification, which is the next benefit. Diversification is a strategy used for investments to lower the risk. Instead of having all of your money in a single stock, you're spreading out your money across multiple stocks. And how this reduces risk is if you have a mutual fund with 300 stocks and one of them goes down, you have 299 other ones that are going up. So overall, your portfolio would be fine. Mutual funds essentially provide you with diversification that would be hard to replicate on your own. Now let's talk about the cons. It's managed by an investment professional. What? How is this a con? I'll tell you. It sounds like a good thing, right? But it comes with a little bit of a catch. I'll explain this and then I'll tell you why this lands in the con category for me. So rather than trying to find stocks on your own, you buy into this mutual fund and there's a manager whose sole purpose is to select stocks that he hopes will outperform the market. He's taken on the responsibility for you of choosing which ones go in the fund. That way you don't have to worry about buying 300 stocks on your own. He's got it covered for you. He's managing which ones are coming in and which ones are going out. Or she, the manager. He's essentially trading on your behalf. Most of the money goes back to the investors, but for the manager to have a job, a salary, and a livelihood, there is a fee. And on top of that, on average, nobody beats the market. You're just trying to match the market. Mutual funds with these fees kind of automatically cause us to perform below the market. And win or lose, whether your investment goes up or goes down, that manager is getting paid. You're paying that fee no matter what. And let's say it's a 2% fee every single year. If you're paying 2% every single year, that's gonna end up costing you hundreds of thousands of dollars by the time you might be ready to pull out all the money you invested. Essentially, this is called actively managed funds and active management. Mutual funds are actively managed. Actively managed usually means high fees. And more often than not, the mutual funds are not worth these high fees. Bringing me to what are index funds? Jack Bogle, CEO of Vanguard, was fed up and he said, hit the like button and subscribe or else. But he also said, I'm tired of mutual funds charging fees to the common man. And so he invented the index fund, which was designed to mirror the market. Index funds are a type of mutual fund. All index funds are mutual funds, but not all mutual funds are index funds. An index fund will clearly state that it's an index fund because it'll have the word index in the title. And unlike traditional mutual funds, index funds are passively managed. Chef's kiss. This means that rather than paying for an expensive fund manager to go in there and trade stocks on your behalf, index funds simply and automatically purchase stocks in order to follow an index. Which stocks get purchased is based on the index. And to me, I just view an index as a big list of stocks. but it also represents a sample of the stock market. The goal of an index fund is to match the risk and return of the stock market, because that will usually outperform any single investment. And it's difficult to underperform the market because when you buy an index fund, you're essentially buying the entire market. If you buy an index fund that follows the S&P 500, you're getting the 500 of the biggest companies in the US. Pretty much makes up a large portion of the market. And since you bought the entire market, you're almost guaranteeing yourself market growth at minimal volatility. And since index funds are passively managed, this means they have low expense ratios, which is our dream. We don't want to be paying fees for stuff that don't need to be paid for. We just want to buy an index fund and hold it forever and watch it grow with low fees. Other things you need to know about index funds is that they usually have a minimum investment amount. So we're typically around $3,000. You can only trade them once per day, and that goes for all mutual funds. You can only trade them once per day, and the trade happens at the very end of the day. So if you bought an index fund at noon, you're not going to have that index fund until the stock market closes at the end of the day. That's not a big deal to us because hopefully we're going to buy and hold these for the next 40 years. When purchasing an index fund, you want one that has the lowest expense ratio as possible and one that follows the performance of the market as closely as possible. What are ETFs? ETFs stand for Exchange Traded Funds, and they were introduced about 15 years after the index fund was created. Index funds were created in the 1970s. ETFs are super similar to index funds. They both have low expense ratios, they're both passively managed, and they both contain a collection of stocks that try to track the market. The two differences between ETFs and index funds are with index funds, you can only trade them once a day, but with ETFs, you can buy and sell them like a stock. So whenever the stock market is open, you can buy and sell an ETF, baby. And it's essentially like trading a single stock is what it feels like when you're working with ETFs. If you invest in an index fund that is tracking the S&P 500 and you invest in an ETF that's tracking the S&P 500, they're likely to perform almost exactly the same. The main reason I can think of that you would invest in an ETF over an index fund is you can't afford the minimum initial investment for an index fund if it's 3 Gs. Solid index funds like VT-SAX or VL-CAX have a minimum investment of $3,000. So a strategy you could take is pound an ETF until it grows to over $3,000, sell it, and then pump it into an index fund. And another reason you might be buying an ETF is because who you buy through doesn't have them available, and ETFs will perform essentially the same as an index fund, so you just buy the ETF instead. 3 more reasons that I like index funds more than ETFs. ETFs, you have to buy per share. So if a share is $400 and you have $500, you can only buy 1 share. You buy a $400 share and then your $100 is just gonna wait until it's $400 so you can buy another share. With an index fund, you can invest with dollars. So after you make the initial investment purchase of $3,000, you can just pump as many dollars as you'd like into that index fund. Got $30, throw it in. Got $500, throw it in the index fund, which makes investing in an index fund a lot simpler and more convenient in my opinion. Secondly, with an ETF, you cannot reinvest automatically. What I love and quite possibly my favorite thing about index funds outside of their growth and performance is that you can set up automatic investments. All this means is with an index fund, you can link it to your checking account and just say, hey, throw in $300 every 4 weeks into this index fund, and then it'll do it. ETFs, you can't do that. And this is at no additional charge, those reinvestments. With an ETF, you gotta go in and say, okay, $300 this month, and then next month you go in and say, okay, $300 that month. It's just an extra step. It's not hard, it's just an extra step. And it makes the investment less passive in my opinion. You could set it and forget it with those index funds. Lastly, and I've heard many other investors say this, ETFs kind of tempt you or have a temptation for day trading because you can trade them like a stock. You may be more tempted to move stuff around, let me change my portfolio, and because people are so emotional and they see like the highs and the lows, they want to change things and they freak out, and ETFs kind of give them more possibility to do that because you can trade them like a stock. But I get that is a con. With any of these that you go with, if you do go with a mutual fund or an index fund or an ETF, I suggest index funds. But whichever one you choose, buy it and hold it for as long as you can. It's all buy and hold investment strategies. And that alone should take out some of that emotional temptation for you, just knowing that you're gonna pull this money out in 20 years or 30 or 40 years. All in all, if I had to rank these investments, I'd say mutual funds come in last because of their fees. Next would be ETFs, and just because it's less convenient and I'd have to buy in shares instead of dollars, and I can't reinvest, but it will still perform exactly the same as an index fund, so shout out to ETFs. Then I'd say the index fund would be the almighty investment in these three. If you like this video, subscribe and hit the notification bell so you can stay up to date on personal finance, insights, tips, things that are going to make you a millionaire in the long term. Comment below which of these investments you think is best and tell me if you invest in any. All right, we'll see you in the next one.